welcome. The government has just delivered a stunningly low fiscal deficit number. The action now shifts to Ministry, to the Reserve Bank and their monetary policy for the interest rate policy, which is due next Thursday. As always, the CNBC-TV18 Citizens Monetary Policy meets to discuss the issues before the Reserve Bank and its committee. Joining me are Chairman Dr. Pronab Sen and members of our Citizens Committee, Sonal Varma of Nomura, Sajjid Chinoy of JPMorgan, Samiran Chakraborty of Citibank and Ghosh of State Bank of India. Gentlemen and Sonal, thank you very much for joining me. For a change, I'm going to start with the chairman. Well, because he's the Delhi guy. Dr. Sen, really, let's start with the budget. The fisc has delivered and how? Deficit has been cut by 80 basis points compared to FY24 budget. Now, how does that change things for the MPC?
What the situation now is that the RBI doesn't have to live in eternal fear of the government going overboard with expenditures. So, I mean, that's a big plus as far as they are concerned. So they can actually start the process of normalizing, at least thinking about it as of now. And so, it really helps the RBI a lot. Moreover, the fact is that private investments still haven't started picking up the way we would really want them to. And so a little bit of support in that direction would I think help things along a lot.
Oh, okay. But Samiran, let me just tweak the government's position. The government has clearly delivered on fiscal deficit, but a big problem for the Reserve Bank is the lack of liquidity. So although there is durable liquidity, they have pumped in a lot of money by buying dollars. The immediate interbank liquidity was terrible. At the turn of the year, the deficit was as high as 3 lakh crore. So is the RBI still going to ask the government, you first spend your money? Will that be a big problem in terms of government action?
This is a more short-term issue, Latha. In our sense, if the government has to meet their deficit target for FY24, then over the next couple of months, the amount of spending that the government will have to do, that will more or less take care of this frictional banking system liquidity deficit issue by end of March. But there are a couple of things here. One is that the RBI needs to communicate with the markets that the reason for the weighted average call rate to stay closer to MSF rate is purely this liquidity issue and nothing to do with the stance of monetary policy, or it is not a stealth tightening that RBI is effecting. The other one is that, is there a possibility of relieving some of this liquidity stress even over this 2-month period? And we think that one of the interesting options that RBI could play with is to think of a incremental CRR cut, which is a very flexible tool, can be reviewed maybe even every fortnight. And that would probably mean that we are not using this VRR auctions as a painkiller to ensure that it does not go beyond 675, but we take some proactive steps to bring down the weighted average call rate back to the repo rate, which is the standard operating procedure of monetary policy.
Now, this is very interesting. The Reserve Bank put a bee in the bonnet when they did a ICRR, incremental CRR cut. Now, what Samiran is asking for the exact opposite, they had done an incremental CRR hike. Samiran is asking for an incremental CRR cut for a couple of weeks. That's a very interesting suggestion, and I hope RBI is watching this. Soumya, what's your take? Do you think liquidity will be a bigger problem than analyzing, inflation or growth at this juncture?
Yeah, thank you, Latha. I think liquidity in the current weeks actually is undergoing a structural phenomenon. I'll explain how. I think if you look into the contours of the liquidity, where the left liquidity has been in negative mode, the core liquidity, which includes the government cash balances, is consistently being surplus mode. The last week, I think couple of days back, the government surplus cash balances was as high as 5.7 trillion, which I think I have not witnessed in decades. So the clear issue is that the government is not spending and the RBI is trying to neutralize that through via liquidity injections. But a larger picture over here is that, whether it is going to be frictional, short-term or long-term in nature. My hunch is that the government is actually trying to move the spending pattern to conditionalities. So for example, the government is actually exploring the idea of a just-in-time mechanism process, whereby the money will be released into the system only if the earlier amount has been spent. So that means that these government cash balances will not be available with the banks, but with the RBI, only with the condition that if it is spent, then it will go directly into the states or the center. If that is the case, I think this will become a long-term issue. And for that, I think I'll just go beyond Samiran's suggestion a point, but I think what the central bank can build into the monetary policy, that it is already done in a counter-cyclical element. For example, the LCF and the CRR could be adjusted when the liquidity is tight, and it could be adjusted also when the liquidity is easy. So basically, making it counter-cyclical and an automatic real-time policy stabilizer in times of stress or in times of surplus liquidity.
Oh, okay. Now, these are some seminal suggestions coming on how to tackle liquidity. For those of you who don't care much about this liquidity issue, the Reserve Bank looks at interest rate for inflation. That is the MPC's diktat. But they have a separate problem of liquidity where a large part of the bank's liquidity is with the government because they're not spending it fast enough. But there is no dearth of liquidity. So that's where the Reserve Bank is in a problem. They want to control inflation, but at the same time, they don't want to tighten liquidity so much that deposits go to 8%, which they are doing now. We'll come to that in a bit. Let me get to the longer standing questions. Sajjid, what is the Fed told us? It seems to be saying no cut now, but it looks imminent in May. So how will that impinge on the Reserve Bank?
But I think the broader point here is that the global environment, which was so threatening through all of 2023 and had become more benign towards the end of 23 as expectations of a soft landing took hold, I think that narrative has gained credence and support in 2024. If you look at where global growth was, despite all of the focus on a recession, even in the last quarter of last year, global growth was solid as a rock, 2.7%. First quarter of 24, running at 2.5%. So I think the expectations of a soft landing have picked up. And while everybody had focused so much on the demand side, the reason that growth is strong and we're seeing core inflation roll off around the world is because the supply side responded much more in 2023 than anyone had expected. This was not just manufacturing supply chains after COVID or food supply chains after the war. It was the fact that in labor markets, you had higher productivity growth and much higher labor force participation. So now the Fed finds itself in a bit of a sweet spot where growth in the US is holding up and core inflation is rolling off. Precisely because growth is holding off, many developed market central banks can take their time. They can afford to say that we're now getting confident of inflation, getting to our 2% target. But because activity is doing well, there's no need to rush this process. So I think that's the message that came through from the Fed, that there will be some easing in 24, but not quite yet. So we do think something happens in May or June, continuing the data. The same message has come through from the Bank of England. Now, what does this mean for emerging markets? There are two kinds of emerging markets. Some of them had raised rates very sharply, preempting the Fed in 2021 and 22 in Latin America. We're seeing sharp rate cuts from them, whether it's Chile, whether it's Colombia, whether it's Brazil. Other emerging markets like in Asia, which had not raised rates so aggressively, can afford to wait and are unlikely to front run the Fed. I think most emerging markets will unroll liquidity tightening measures, maybe pivot in terms of language, but are unlikely to cut interest rates till the Fed actually makes the first move.
Okay. So, well, that's a clear warning that the RBI also perhaps cannot move till the Fed clearly gives an indication. Sonal, ultimately the MPC has to look at inflation. We got two readings below the Reserve Bank's forecast and the market forecast. What's your sense? Should we expect the Reserve Bank to guide lower, bring down its forecast for current year and next year?
Latha, I think inflation focus should largely be retained. You're right. I think at least on the food side, we've actually seen a more broad-based decline in prices in January. And encouragingly, the food shocks we saw end of 2023 did not result in any second-round effect. So the drop in core inflation to below 4% is extremely encouraging. I think we're on track to get about a 5.4% for FY24. And FY25, the RBI's projection of 4.5% is largely on track. The two main risks to inflation going forward are the uncertainty on food prices and geopolitical related disruptions. But the drop in core, we think, it does imply that beyond the next 3-4 months, where high food inflation will keep headline inflation around 5%, we should see headline inflation converging to core around 4% beyond June. So we do see bulk of FY25 seeing core inflation below 4% and headline actually converging to core. So there isn't any need to change inflation forecast. There are risks, but I think things are looking much better.
Okay, that looks very satisfying if inflation is going towards core, but I need to take a break. And thereafter, the more important questions on how you guys will expect the MPC to vote on both stance and on its rate action. Back in a jiffy.